Our next presenter, most of you probably know, as I alluded to before, Shane Caldwell. He is a CEO of Ballator Insurance Group, and he's going to give a state of FIT and general overview of where we're at today.
Thanks, Peter. For those of you that don't know me, my name's Shane Caldwell. Welcome. We see a lot of the old faces here. We got a lot of new faces. So my presentation is really simple. I just want to the best of my ability, explain to you what's happened in FIT in the last year, and then further that, talk about what we see in the insurance market for the coming year. Joe hit on one of the tenets that we've always had, which is stability. I mean, even more than price, it's stability, stability, stability. The other thing that we hang our hat on, and if we don't do this, we expect you to tell us, is no surprises. And so we try and do that by having this annual meeting. There is no question you can't answer. We'll answer it to the best of our knowledge, and if we don't know, we've got the people here who can answer it. One of the things I want people to understand is because we are the main administrator, nonprofit insurance services, people tend to think we're FIT. We're not FIT. This group is FIT. There is actually north of 225 members. FIT is a member-owned pool. We're simply hired guns. We hope we do a good job, but we work at the behest of the board of directors, who works at the behest of you. So anybody here who does not think they can call us up and ask us a question at any time, I want to get past that right away. We're an open book at any given time. This is one other thing. I try to make this somewhat interesting, but because we have so many new faces, about half of this presentation, the folks that have came every year, I ask you to bear with me. But it's certain stuff that we think is really, really important to know for the new folks coming in, because there's certain misconceptions about pools, kind of starting off with what a pool is. But those of us, and I know most of you haven't been to our office, there's no secret to this. We're holding this in Orlando. This is the skyline of downtown Orlando over Lake Eola. Our office is this little white office right here, and you can't see it on this screen, but the big top of the building says Morgan & Morgan. No joke. There are like 15 floors on this building. We have one and they have 14. So we see John Morgan every day, and people, I can assure you, in this audience, there's two types. Those he's already sued, or those where it's coming. That's just a fact. So the first thing, there's this notion, because this particular group, nonprofits in Florida, it was in 2000, we worked for about 3 years to try and get the legislature to pass a law that would allow this group to pool. There's a whole bunch of other groups that pooled. It took us 3 years to get it done, but in 2007, we got Florida Statute 6244622 passed, and that allowed this group to pool. So for this group, particularly the newer members, if you've been here before, you've seen some of these slides, but if not, I just wanted to give you an idea that pooling is not a new concept at all. I mean, in fact, if you go back through time, for the first 5,550 years of insurance as a type of product, there was only pooling. I mean, if you go back to ancient Babylonia, 3000 BC, the very basics, they didn't even call it, obviously, insurance pooling back then, but the concept of jointly purchasing and spreading of risk. So back in Babylonia, if you had a ship and you sent your ship out with some goods and your boat went down, you were out of business and you were in real trouble. So 10 people got together and they said, well, you know what? If we take 1/10 of our product and spread the risk, if the ship goes down, we've only lost 1/10, and by the way, we can actually afford that. So that actually, as far as 4,500 years ago, was the first concept of insurance, which is the pooling of risk. And that was it. There were variations of that in China. I mean, this all goes back through written history. Modern insurance as we know it was still pooling. Most of us know John Lloyd's coffee shop. We've all heard Lloyd's of London. It's kind of a fancy, cool thing. We actually go over a couple, 3 times and visit the folks over there. But I mean, this was about 1600, and Lloyd's was simply a coffee shop in London where the boats came. So a lot of the original insurance had to deal with maritimes. So what they did was they formalized insurance, which instead of manually moving all that product between 10 boats, they said, well, we can just do it with the contract. And so inside the coffee shop, it's actually still there. There's a big board. and you would go in and you would put up a piece of paper and you would say who the captain is, where you're going, what you're carrying. Who better to know what the appropriate price for that is than the other people that are doing the same thing? Exactly how pooling works. We got a bunch of different organizations, but as a group, you guys are much closer than a lot of for-profit corporations that do the same thing. Most of the people in this operation are similar in thought process. We want to be on the same thought process with you. Benjamin Franklin, my favorite historical character, he started the first insurance pool in America. And of course, Benjamin Franklin started a lot of things. So right after he started the first fire company, which everybody knows and is well documented, he started the first insurance pool. And here's how it worked. This guy was really smart. He started the first fire departments in Philadelphia, and then he started an insurance company. And a lot of these terms that we use every day, you don't know where they come from. Watermark. We all know the term watermark. Well, what he did was he formed these watermarks, and for a premium, the first time premium was used, for a premium, he would give you a watermark, and you would put it in front of your house or business, and if it caught on fire, the fire department would put it out. If you didn't have a watermark, you were screwed. I mean, this is honest history, guys. So the first commercial insurance company started in the 1800s, kind of as you would think of general insurance companies. And then in the 1900s, really 1960s, pooling as FIT is formed really started, and it started on the governmental side, and we'll talk about some of how that developed. But the main point is pooling goes back 5,500 years. This is nothing new. As a matter of fact, Lloyd's of London is now a commercial organization. From its formation in 1600 until 1994, right after Andrews, Lloyd's was a pool. There was no corporate money. It was called name at Lloyd's, and people put up their full net worth. And I mean, it's the ultimate form of pooling. And it was like that after Andrew. They had to go to tens of thousands of people who were names and ask them to cut huge checks. And after they did that, they didn't have as many people that wanted to be names. So they paid all the claims, but after that is only when they formed as a insurance organization that allows capital in from the commercial side. Again, back to what we're doing. This is a very abbreviated list. Who can pool for insurance in Florida? It started out with municipalities back in the mid-1960s. Public utilities, housing authorities, independent educational institutions. That includes private K through 12. That includes private colleges and universities, electric cooperatives, nonprofit organizations, hospitals. I'm sure I'm missing a couple, but again, these all came on the ability. There's separate legislation for each one of these classes to allow them to do this. And if you look at what the flavor is, it started out with government, and all these expansions are stuff that it's still civic service. So we know what we do as nonprofits, but if you think about it, electric cooperatives are a great one. There's 13 electric cooperatives in the state of Florida. You know how many purchase from a pool? 13. And they have for a long time. That was the mid-1970s that they were allowed to. So, I mean, just the fact that we got our law passed, we're the most recent as far as I know, which was 2007. I know the one right before us because we had a hand in it was private colleges and universities. But I mean, a lot of the organizations that you know buy from pools and have for a long time, but it's kind of silent because if you're not eligible, you don't hear about it. So that's why a lot of the folks in this room, this is the first time you're hearing about it. Okay, the life cycle of a pool, and this is really interesting. I didn't realize until we put this slide together how similar, almost eerily similar this is. We've titled this sample pool. Well, I guess we didn't go ask them for the use of their name. They wouldn't have minded. This is a Florida public entity pool that one of our companies administers. It's based out of Fort Myers, Florida. It started in 1987. In 1987, and I'm going to point because when I first came in, I sat in the back and I realized you can't really see the stuff in the back. So it started in 1987 with 7 members, $5 million of premium, which almost all of these classes, that's part of the statute. You have to start with a critical mass. If you don't have enough, you don't have enough staying power. So almost all these classes, it's required to get it started, you have to have $5 million of premium. So it started 7 members, $5 million of premium in 87. FIT started in 2007, 20 years later. Okay, so let's go forward 11 years. After 11 years, the pool is up to 30 members, 20 million in premium, and 1.5 million of surplus. After those 11 years, FIT has more members because these organizations are not as big as cities and counties, which makes up the government pool. Premiums were almost identical, and the surplus is almost identical. FIT is at 1.25 million. This was at 1.5. We stole this slide from something else. In '99, they started offering group health insurance. We've talked about that quite a bit here, and actually a lot of people don't know, but the president I'm not sure if it was a presidential mandate, but they've just allowed association plans. And if you hear about these things, I believe we'll probably come out with one. We qualify for one, but an association plan essentially is a way, as it's been described to me, to allow organizations to get around Obamacare. They're having a real hard time getting rid of it, but via these association plans, you don't have to adhere to Obamacare. So we'll follow up on more on that later. But the interesting part is in 2007, this pool was up to 48 members, 28 million in premium, and $22 million in surplus. Now you say, well, what happened? 11 years you gained from virtually nothing, but from here, how do you have 9 years later, you got 22 million in surplus? It's because when you start a pool, you have to retain, because you're small, a little bit. So, I mean, the money comes in, you give it to an insurance company, and in general, the insurance company pays the claims. I mean, we pay it on their behalf. As you get bigger, you start retaining some risk. And on that risk you retain, you keep the money and you invest the money. A lot of people don't really understand the insurance industry through all of time, if you include everybody, has not made $1 in underwriting losses, which means for every dollar you give them, they pay out more than $1. The key is they pay it out over time and they make all their money on investment income. So as a pool, you get to this point, you start to get a little bit of money, and then all of a sudden, when you get to 2007, because of compounding interest, you're up to $22 million. That's kind of the curve that FIT's on right now. We're kind of right at that point. We actually are almost identical in surplus, but when a couple slides back, we'll get to the financials, and you'll see we have a tremendous amount of cash sitting around now. It's invested, and we would expect probably not this much, because the board of directors here are much more proactive, and before we get this much money, I can assure you they're going to tell us to give it back. But the key is, in 10 years from 2007 to today, when the board realized they were sitting on $22 million in cash on $28 million in premium, the members in a forum much like this said, hey, times are tough, give some money back. So this pool, real world example, in Florida, from 2007 to 2017, returned $20 million to their members. Now, how are they sitting today? They got 61 members, they got 32 million of premium, and they still have $9 million of surplus. They could still give back more money. They're very conservative. Government agencies, because of the way they get their funding, a lot of times they don't want a bunch of money back. I can assure you, everybody in this room, because of the way you get your money, would probably want your money back before we develop $22 million. All right. So, I mean, that's what pooling's about. Now to talk about the state of the market. This first one is on property, and I'm going to point, because again, I know the people in the back can't see these numbers, but I'll just talk about the general way that it's going. Okay, in Florida, we know that we live in a catastrophe-prone area. And so we kind of judge how we think the world's doing by, hey, we hadn't got hit with anything this year. North Carolina got hit with a little blow, but nothing big. The issue is these global insurers, all the property capacity in the world, when you get it up to the top, whether it be banking, insurance, it's one big pool of money. And from an insurance standpoint, the same folks that insure our stuff here in Florida insure Taiwan and Bangkok and the Philippines. So a lot of times we feel we don't get hit here in Florida. We think, man, the insurance market's doing great. Where, I mean, I'll give you, for instance, the big tsunami over in Japan a couple years ago. Well, it was a pretty good year for us here, but obviously that was a catastrophic loss. So if you look at what's happened, In 17, there were 710 events that totaled 330 billion of losses. Now, of that, only 135 billion were insured. So there's a lot of stuff that's not insured, as we all know from getting hit by storms. If you go back to 16, there was 780, but the overall losses were about half. So 16 wasn't a really bad year, and the key is only 50 billion of that was insured. Nobody knows the exact number, but you can talk to all the prognosticators, and the insurance companies, the insurance market, can pretty well handle about $100 billion a year where it's only a profit event. So at 100 billion losses, they probably don't have any profit, but it hasn't eroded their capital base, which is what allows them to write business. Once you get above 100 billion, you're really talking to them. It's hardening. So while we feel pretty good in Florida this year, I mean, I'm not going to jinx us, but everything's based off of 17, and that 135 billion is about 35 billion more than those folks had planned on paying out. So it's not bad news from a property standpoint, but it's also not good news. I'd love to be standing here going, the overall catastrophes were low and we're looking for decreases. I mean, I think there's stability in the market depending on the attributes of your risk. Some people will see decreases. Some people are going to see marginal increases. I don't think anybody, unless it's loss driven, is going to see any big jump in the property insurance market this year. This is just a little more, just to give you an idea of how the breakdown goes, but this is the property market. You know, you can see the two big things, the three big things are Harvey, Irma, and Maria, which are all in the United States, but you see the landslides in China, the earthquakes in Mexico, the water damage in Europe, the drought in Europe. How you can have water damage and frost and drought in the same year is kind of hard to understand. Floods in Southeast Asia, and again, it's the exact same insurers. I mean, I can run through the names of them. It's the same folks. All right, they put this one in here. I didn't prepare this. This is a joke. I could do this job. The prognosticators of who's saying how many hurricanes we're going to have, this has got to be the big, this is like a weatherman in Florida. It's going to be really hot with a chance of afternoon rain. I could do that. I could do this job, but here is what the prognosticators from the University of Colorado, who usually does this stuff, listen to these numbers. I'm saying this because it's such a joke. There's a 35% chance we'll be above normal. There's a 40% chance we'll be near normal. And there's a 25% we'll be below normal. Really? The named storms, they've projected 10 to 16 with 5 to 9 hurricanes. Those numbers are usually so close every year. What it really comes down to is the path they take. I mean, the number of storms every year doesn't vary that much. This year, you know, knock on wood for all of us, at least as far as Florida and the Southeast goes, we're looking pretty good. I mean, there's been a couple of super typhoons, but luckily from a losses standpoint, they hit areas that they don't sell a lot of insurance. So those losses probably aren't going to get into these guys' pockets that deep. Here's the bad news. Auto liability. Man, this is really getting bad. Auto liability losses across the country, personal lines, commercial lines, all of it is going really bad. People are seeing 7.5% to 20% increases, both in their personal lines and in commercial lines. Obviously, organizations that have transportation component, so transporting clients, multiple passenger vans, which we have a lot of, because of the experience, they're seeing the highest rates of increases. And really the deterioration is based on 3 or 4 things. The 2 biggest things are, you know, I think we can all just common sense, distracted driving. You know, 10 years ago, we didn't all have texting and stuff going on. And then 2, is the growing cost of vehicle repair. It's really cool that every car in the world has 3D vision around it and you can see who's coming up. The problem is when you have a little fender bender, it used to be $3,000, now it's $18,000. So the technology is great, that stuff where it's supposed to stop you. I haven't tested it, but it should work. But when you have a fender bender, it drives the costs up. And when you realize that most auto losses aren't fatalities, they're fender benders. If that number is 3 or 4 times as high, the losses all of a sudden really mount up. So the auto liability, now again, for FIT, we've had a couple big pops. I mean, I'd say at this point, we're big enough that each year we're going to have at least one multi-million-dollar auto loss. But I've got a slide coming up that shows you how we handle when that happens and how it's different from an insurance company. General liability, professional liability, we're in pretty good shape. Both from a market standpoint as well as a FIT standpoint. The losses have been pretty reasonable. They're exactly what you'd expect. They're the same types of losses we've had for the 11 years that we've ran the program, and probably goes back 30 years in the state. Now, you do have to take into account, Florida is one of the most litigious states in the nation. We actually just did a study, and in the Southeast, I mean, Florida, when we use a factor for the other states, the only one that's close is Louisiana, which is like a 0.9. The other Southeast states, Georgia, North Carolina, South Carolina, I mean, we're talking litigiousness rates that are 30% lower than Florida. Sexual abuse and molestation coverage continues to be a concern in the marketplace, especially for social service organizations. We know this exposure. I can't tell you when we're working with our reinsurers how much time we spend explaining this. We've been very lucky, and we have not had a bunch of this stuff. And when we have, luckily we have claims professionals and crisis teams that can jump in and help minimize this stuff. But it's still an exposure. Mental health and behavioral health organizations are also facing additional scrutiny. A lot of it because of the active shooter incidents, which that's a coverage we'll talk about in a second. Work comp. The good news is probably bad news. Yeah, I mean, it's the last, you know, and as everybody knows, the OIR accepts the rates proposed by NCCI, who's the national governing body. And they increase rates, then they decrease rates, and they increase rates and they decrease rates. Well, it sounds like good news, because right now they're recommending a 13% reduction in rate effective January 1, 19. That sounds good, with the exception of, before this year, there were really 3 organizations that would write insurance for social service organizations. FIT is the only one that actually has freedom of rate, which means under the statute we're formed, we are not mandated to use the NCCI rates. So we can charge more, we can charge less, and it's all based on experience. So I mean, people in this room, when they're looking for what they're doing, we just sit down with their experience. Some people will see increases, most people will probably see some decreases. But where it sounds good is the other 2 carriers are tied to NCCI rates. So I think they'll probably just not write it, because if you're an NCCI carrier, your choice is 2 things. Here's the price, I write it, or here's the price and I don't. So I think that this is actually terrible for our organizations, because we're going to have less competition, or almost no competition possibly. Loss ratios for social service organizations tend to be high. The reason that the loss ratios tend to be high is the rates are like critically low. To give you an example, a lot of organizations in here pay between 1% to 3% of total payroll for workers' comp, whereas a roofer pays 90% for work comp. So, I mean, obviously a roofer has a lot more exposure. That's why the rates are higher. It's not 50 times as much. I mean, when you look at the losses, it's just not. Some of the benefits of pooling. As you've heard and you'll continue to hear, Joe said it, stability, stability, stability. Customized services, we do have the spread of risk, which really does take away that cat loss knee-jerk reaction. The ownership and the trust, which obviously, I mean, that's what we want everybody here to feel, that you're really part of something and you actually have a say in it. Cost of savings, I mean, and the reasons we have the cost of savings is we don't need to develop excess surplus, and we take all the administration, and I got an example of this, we squeeze it down. So it's no secret as to how we tend to be more competitive. Group purchasing provides greater leverage when negotiating with the excess carriers. I think everybody here understands the benefit of pricing power, and the convenience of purchasing all of your insurance from one cost-competitive company. I have to go through that slide every year. Most people have seen that before, but I mean, that really gets at the heart of what we're actually doing. Another one that I have to show every year, it's obligatory. Things you should know about FIT. We are the only not-for-profit trust. The law is still there. Somebody else can go and do it. It takes a lot of investment of time, energy, money, and resources, and you don't get rich off of it. I mean, we get paid a fair fee, but it's not something that you get rich off of. It's governed by a board of directors. They have to be members. We do report to the Office of Insurance Regulation, and every year we have to give them an independent audited financials, which is available to anybody, an independent actuarial statement available to anybody, and then in 2014, just because the requirement in 624 is that organizations get 75% of their funding from government. 75% of the organizations in this room, it's pretty easy. We go to the Form 990, there's a line for government funding. If it's over 75, we're clear. The problem is with like some of the health organizations, particularly the physical health, they get government money, but they get it indirectly. So they'll get it from Medicare or Medicaid. So when we go to the Form 990, it says 52%. Then we actually have to get the financials and dig in and do the calculations. So we purchase excess insurance from only authorized insurers who list every member as a named insured. So on our excess policies, everybody has access to them. So I mean, yes, FIT is providing the primary coverage, but everybody in here has insurance policies from some of the biggest and best insurers in the world, which we've got some of those here, and hopefully you'll get a chance to meet them. The trust retains very little risk. I mean, the majority of it's transferred to A-rated carriers. The incremental cost goes down with every member. So if you look at all of our fixed cost, a lot of them don't go up. I mean, we have to have an actuarial study. We've got to get an audit. We've got a whole lot of expenses that don't necessarily go up. So existing members do benefit from new members coming in, which is why we ask you guys to be our best sales force and go out there and help us spread the word of mouth. And yeah, that's the last point is our best marketing is you guys talking to your friends. If we're doing a good job, please talk to them. If we're not doing a good job, please talk to us and we'll fix whatever it is. I think people know, again, obligatory. The coverage is available: property, general liability, professional liability, directors and officers, workers' compensation, commercial auto. And then over the past year, we've been able to offer terrorism, active shooter, and cyber crime, which we've seen a pretty big uptick in. It's obviously gets a lot of press, but I mean, I know our little organization, we've actually been hacked 2 or 3 times in the past like 6 months. Now, luckily, we've been able to stop any critical data from getting out, but with as much data as your organizations have on people, particularly the mental health organizations and the physical health organizations, that's a big concern. And of course, because it gets so much press, the active shooter, we added that coverage. We didn't really go out and tout it real loud, but we just knew it was an issue for our members. And we've actually had some activity on that. I mean, we're involved in some claims that involve active shooter. The FIT service providers, we're the front line. And you know, when I started, I said, look, NPIS is not FIT. I mean, we're the most visible, but I mean, we got an independent actuary, we got an independent accounting firm, we've got independent legal, we've got York doing the claims and loss control, I think most of you know, and then we got our agent partners, which several of them are here. So I mean, while we're the ones that put this thing on, there's a whole lot of people that provide services, and I mean, we're one of 6 service providers. An interesting one: why don't FIT need as much premium as standard operating insurance companies? It's really simple. We take the administrative component of it and we squeeze it down, which this takes commitment on everybody's part, because the administration, if you look up an insurance company, it's usually about 16% of premium. In a pool, it's 10. So there's a 6% savings. The commissions that we pay to agents for servicing, this is not an easy sell for us to go to agents and say, you're going to make less money, but it's going to be consistent because people aren't going to leave. The typical commissions on work comp is usually 10%. The pool pays 6%. On P&C, the typical commission is 15%. The pool pays 10%. So if you look at those two, that's close to another 4% difference just in the fixed expense side. And the taxes under our statute, every insurance company has to pay premium taxes to the state. A company is based online between 3 and 5%, so call it 4% on average. We pay 1.6%. So if you add those up, that's about 12%. So to start off, we just have 12% less expenses than a typical insurance company. So we start with that, and if you look at how much we're cheaper, it's typically somewhere close to that. So I mean, that is what actually drives the initial savings. Then we get to what keeps the pricing down. We have industry specialized claim handling. York, we have a dedicated team that's all that they do, or handle claims for this group of people. They've probably handled more claims for this type of people than all the other carriers that do business in the state combined. This is all that they do. We have specific claims people that handle specific types of claims. That's really what makes the thing stay stable. We still have very few legacy claims open. I mean, we're constantly looking at those, and our policy is, I mean, we're going to vehemently defend claims, but we also understand there's an impact on your organizations, and sometimes we need to work to close those things out quickly. And we actually, ultimately, we have to retain the ability to do whatever we need to, but we actually allow your organizations to have a say in the claims and to explain to us what's going on and how it's affecting you and your board or whatever it would be. No compensation for the board of directors. These guys that have been with us from the start, great business guys, no compensation whatsoever. They even come to the meetings on their own nickel. An insurance company, the board of directors are, you know, they get paid a lot of money for not doing a whole lot. And we provide all lines coverage. This is a hard one to quantify from a standpoint of you have to believe it because you see every insurance company in the world, they've all got a different spin on it, but it all comes down to bundling. What it really comes down to is if you have an organization on any given year, it's likely you're going to have a claim. Auto, GL, a bad one. It's less likely that you're going to have bad claims on all lines. So we're a little bit different, but Geico and State Farm and everybody that's bundling, there is a rationale behind that. It's not just marketing, it's actually the numbers bear it out. Here's an example of the loss where I've talked about it. These are actually two losses. So in the first one, member one had a loss in year 3 with $1 million paid. So if you look, here's before we took over, it came down. They had $1 million loss. It did go up a little bit. They didn't get non-renewed. They didn't get a 30% increase. They got a little increase, and then next year it started going back down again. Same thing with member 2. They had a loss in year 2. So premium came down, had a little dip, went back to coming down. That's because we understand you wouldn't buy insurance if you weren't going to have losses, but the key is it's kind of a random. Now, if we see an organization that has bad practices, our loss control people tell us that, then we got to sit down with them and have a serious heart-to-heart. But in general, I mean, it's just a roll of the dice. All of us could have a claim any given day. We all know that. So to us, it's silly when you're here to pay claims and somebody has a claim and you non-renew them. To us, that's disingenuous. That's not a partnership. Why should an organization purchase all lines of coverage from FIT? And again, I could make this true for pretty much any other insurance company or organization in the world. Provide stability in premiums, dedicated experienced claim team. We do have a package credit, so we see the numbers and we share the savings with you. Ease of administration for your staff. I mean, when you're dealing with a bunch of disparate carriers, it's really terrible on your staff kind of keeping track of who gets what claims and what's the reporting requirements. Eliminates the potential for claims conflicts. And this is very serious. Probably the easiest one for me to give you an example, because we see a lot of them, are auto and work comp. You got an employee. He gets in an auto accident. He's driving a few clients in the back. So you got a work comp loss on the driver. You got a liability, auto liability on your patients. And you ran into somebody else. So you've got an auto physical damage claim. Having different carriers, you often end up in claims conflicts. So for instance, if we've got a client and we're taking them down the ramp off of a vehicle and they fall forward, these are claims that happen. Is that an auto liability or is that a general liability? It happened on an auto. It was one of our clients. We're responsible either way. If you have two separate coverages, the auto liability could say, it's nothing to do with the operation of an auto. The general liability could say, we exclude auto coverage. And we've seen that a lot of times. So these are true. I mean, there's actually some benefit to having your carriers, because what you want to say is, I don't care, handle the loss. You call it what you want to call it. All right, some of the financial highlights. So far to date, we've paid $107,898,000 in claims on behalf of our members. Now, this I know from the back is going to be very hard to see. By the way, all of this stuff is public information, and anybody wants a copy of this to kind of be able to read the numbers if you can't really see them. But essentially, between the end of last year, here's the 2017 audited numbers. We ended up with $33 million in what we call member contributions. Those are premiums. So over the last year, we grew from $33 million to $39 million. Of that, we've spent $11 million to buy insurance on your behalf. The loss-related expenses, we paid $18,461,000. Of that, I think we've got a slide that goes, we spent about $2.5–3 million on Irma claims. The underwriting expenses, which is that percentage that I said we squeezed from 16 down to 10, is about $10,327,000. And so the net income, these are unaudited, but our audit is due to the state by December 1st each year. So we're in the throes of it. So this is going to be very, very close, is $225,000. And our stated goal as an organization, and this has not changed from day one, is to put between $50,000 and $250,000 a year into surplus. If we're putting more than that, we're charging you too much for insurance, and we need to adjust our pricing. The balance sheet. The vast majority of our assets, we really have two classes of assets. We've got cash, and at this point, we had $11 million in cash. And then we got receivables either from you in the form of deductibles or from insurance carriers in the form of something that's exceeded what our retention is. So when you add that up, we got $28 million in assets. And then our liabilities are really, really simple. Unpaid losses and loss adjustment expense, $26,502,000. There's a couple of payables here for small amounts, but our real liability are those dollars that we have to pay on your behalf. This fund balance, that's eerily close. If you'll recall back to the PRM balance, it was 1.5. We're at 1.41 at exactly the same point. 10 years later, they had 22 million and gave back 20. I can't promise you that's going to happen, but this surplus right here, and this is where there's a lot of confusion, and this is where our opponents say they've only got $1,400,000 to pay claims. That's bull. That $26 million is sitting on the sidelines invested to pay those claims above what the actuary tells us we need. We've got an additional $1.4 million. So this whole thing about you pay claims out of surplus is a bunch of book. I mean, it's not. You pay claims out of reserves. Surplus is what you have, just like it says, over and above what you need. It's a little bit easier to see when you just graph it out. If you look from 2008 to 2018, a 10-year period, we've had pretty linear growth. We've had some years that were a little bit worse. If you look at the written premium, it's pretty similar. I mean, we've had some years where we stayed kind of flat. We've had a few years that accelerated. But in general, we've had, in every class, however you look at our financials, claims incurred. It's the same kind of slope. And we've got slides, obviously, that superimpose these on each other, and you can see how close they are, and they're pretty close. And again, an issue that comes up very often from our competitors, our surplus, you can look, we've had a stated goal to add between 50 and 250, and every year we've been between that. And so it's grown linearly. Strong financial stability and protecting our membership, that's what our balance sheet and our claims payment process is for. Here's our excess structure. I won't kind of bother you with it, although some of you have seen it. More importantly is to see the names of these carriers that are on here. Markel, who's got some representatives, are here. One of the biggest and best reinsurance companies in the world. We've got RSUI, very good. You can see all of our primary property is Lloyd's of London. We talked about them earlier today. So if you look at the financial strength of who's really behind FIT, it's Markel, who is an A-rated Class 15, which, by the way, on these best ratings, the letter denotes how good they think the management of the company is. The number just denotes how much money they have. So A15 is as high as it gets. Financial class 15, I believe it's $4 billion or more. But you got Markel, you got Lloyd's of London, who is also an A15, and you got RSUI, who is an A13. Oh, it actually says up there it's $2 billion or greater. So if you look at that layering of who retains the risk, these four carriers are responsible for the majority of, and in fact, all of the big claims. So somebody says, well, how are you going to handle an $8 million loss? Well, FIT, depending on which line, is going to pay between $150,000 and $350,000, and these great big boys are going to pay the rest of it. I actually put this together. It's kind of funny. I've shown the same slide for 9 years, and these are scenarios. These aren't real ones. The pool scenario I gave you earlier is actually a pool. These are ones where I was talking about an example of a loss, and this number one is one I completely made up 9 years ago. A Category 4 storm makes landfall in Dade County, goes directly up the center of the state. 50 FIT members suffer losses totaling $75 million. FIT, in that case, would pay zero. We don't retain a dollar on property. The property carriers would pay $75 million. We just had that storm last year, and the losses were $3 million, not $75 million. But if it had been $75 million, those property carriers, starting with Lloyd's of London, would have paid their $75 million. Loss scenario 2 is just involving an at-fault auto accident. We've had a claim very like this too. A driver carrying 4 clients crosses the median, collides with an oncoming car. The driver of the other car and 3 clients suffer severe injuries, $1 million in damages. In that case, FIT would pay $150,000 and the auto carrier would pay $850,000. In loss scenario 3, a FIT member has sexual harassment claims by a supervisor. Regrettably, we actually still have quite a few of those. The employee files suit for his hiring practices, settles a suit for $400. FIT, again, pays $150, and the professional liability carrier pays $250. That just goes to, again, to reinforce how financially stable we are because of the carrier partners that we choose. This is a property map of Florida. Each year, we strive to improve this. We really strive to improve coverages, pricing, and terms include deductibles. If you go back 3 years, almost the whole state was at a 5% wind deductible. We've improved it each of the past 3 years, and again, just last year, these areas that are in blue are still the 5% wind deductible. Last year, that 5% included everything up to Tampa. So all these counties that are now at 3%, and those are actually for where your locations are based. So we now have only 5% for a very small part of the state. We've got a lot of 3% on all the coastal areas, and all the inland stuff we've negotiated down to 2%. And until you have a property loss, a wind loss, these don't mean that much to you, but we'd be happy to sit down and show you the difference that's going to mean to your organization when you actually do get hit. And those of you that have been working with us that you did get hit, I mean, we really pride ourselves on that $3.5 million that we paid out. We paid out very, very fast. Here's what happened from the hurricane last year. This is as of 9/27. We had received 228 property claims. 91 of those were reported in the first week of the storm. We had a total of 55 members that were affected. Most of those were affected had multiple locations. And the good news is much of the damage reported was minimal, but we did have several large losses. That is what the deductibles do. Until you have a location disappear, it really seems that these property carriers aren't looking to pay much because they got these deductibles. But when a building disappears, trust me, they are very quick to pay. And our governmental pool had opposite experience of us, just luck of the draw. There was massive claims, and there was massive payments, and there was massive payments very fast. Okay, this I know nobody's going to see, but this is the modeling that the whole insurance industry is based off of. It's called, there's 2 models, AIR and RMS. And this is how they modeled Irma. You can see the noodle models that look just like what they show you on the Hurricane Center when they're coming in. So this is how they modeled Irma for us. These are the various paths, and it takes into account where all of our accounts are and how much TIV is there, and then it gives us probabilities. And I know nobody can see this because I can barely see them here, but I've got another slide that may show you. So when we model, and we model this every quarter, and we update our appropriate limits, this is the modeling that everybody would see. And what it does is it gives you probability, and it goes from 20%, which that means you're going to get hit on average one every 5 years, and ground up losses for us would be 1.2 million, and you can see how detailed it gets up to 0.1%, which is the 10,000 year event. We currently purchase 150 million of property coverage for our members. To put stuff in perspective, that 150 million is almost double the 1,000 year event. Until you realize that the Office of Insurance Regulations sets using the same models, they mandate the model that you use, the floor to take out insurance companies, of which there's 32. So these are all the companies that are taking people out of the residual market. The state mandates that they buy reinsurance up to the 100-year event. We're buying to the 2,000-year event. To be an A-rated insurance company in the state of Florida, the state mandates that you buy to the 250-year event, and we're buying to the 2,000-year. And that's for three reasons. One is to give everybody peace of mind that we've got way more than we actually need. Two, it just makes sense to us because the insurance carriers believe in these models so much that once you get above that 250-year storm, it actually gets pretty cheap. They believe in it so much that, I mean, underneath it, they're going to charge you a ton, which they do. So we're extremely conservative. We could probably grow for another 15 years without ever adding any, it's called probable maximal loss, PML. But we look at this every quarter, and I'd venture to say about every 2 or 3 years, we'll be increasing it as we can. Here's some of the coverage enhancements. And those of you that had a loss, a lot of it came from these areas. Building ordinance or increased cost of construction. We have a lot of residential homes. If they go away, a lot of times they're older facilities. They're not sprinklered. They didn't have to have certain roof straps. The new codes say that you do. A typical insurance company gives you what it was to build the old cost. Obviously, that additional cost has to come from somewhere. That's building ordinance. 10 million in E&O and miscellaneous unnamed conditions. I would venture to say there's probably not an organization in here that doesn't have property that they've either mistakenly left off the schedule or just flat out don't know that they have. Maybe it got donated from an estate. If that goes away, you still have a financial loss. We actually have 10 million in coverage. Don't everybody go back and start erroneously forgetting locations. But if you do make up to a $10 million mistake, we got your back. Debris removal, it's at policy limits. A lot of these storms, you don't have a lot of damage to your structure, but there's a huge amount of debris removal. We actually cover that up to the policy limits. Flood and storm surge is covered. This is one of those nuances that if you don't really deal with insurance all the time, there are different definitions of what is storm surge. So if a hurricane comes in and you get the storm surge that comes inland, is that flood or is that wind? Well, you can buy property insurance, and if you don't know enough to ask, and if you're not an insurance professional, I wouldn't expect you to know it, but that makes a big difference, because if it's wind, you're going to have a wind deductible of 3-5%. And we're not an ISO-based form. ISO is insurance service offices, so we have a manuscript form. There's no co-insurance. Co-insurance is a penalty, and it's usually like 80 or 90%, which says after a loss, we're going to come and adjust your loss, and if you didn't have enough, we're only going to give you a percentage of what the loss is. We don't have that. Ours is replacement cost. You're going to get what it costs to replace it. A margin clause is essentially the same thing. A lot of our competitors, in fact, probably our major competitor for property is an organization called AmRisk, which, notably has not paid any Irma claims out yet. And they have a margin clause, which says the margin clause is typically 20%, which says whatever you have scheduled at that location, let's say it's $1 million, we will only pay up to $1.2 million. If it actually ends up costing $4 million to replace, you're going to get a check for $1.2 million, where with us, you're going to get a check for $4 million, the actual loss sustained. Recent updates and key achievements. Back to the no surprises. I think everybody had this result. Quarterly, we always get together with the agents. We talk about what's happening in the market. We Obviously, annually, we get together and give you the State of the Union, but at any given time, you can ask us what's looking forward. And our absolute commitment, when we first got into this business in Florida, it was amazing to us how many people, insurance is probably your third or fourth biggest line item, and you would get renewal indications 3 days before. I mean, we don't play that game. Our commitment is you will have a renewal number 30 days before expiration, if not more. We actually go out probably 90 days ahead of time to have expectation meetings. So if you need to budget, if there's not going to be a surprise, you're going to know what's coming. This past year, we actually put financial support of over $200,000 a year into a combination of our members and the associations that we work with. We've held regional workshops and webinars on topics of interest around the state. Those continue to get bigger and better, and we'll continue to do more of them. Our manuscript document has been enhanced, and I'm not going to get into all the enhancements, but the stuff like the active shooter, all of those types of enhancements. A lot of you took advantage of something that we have that nobody else in the market has, which is evacuation coverage. A lot of you guys did because there was a lot of evacuation cost. Focus on improving loss control and safety. Jennifer's going to talk a little bit more about that, kind of the value added that we try and do. And we increased the wind limit, even though by the modeling we didn't need to. We just thought it was prudent. Now, the other thing we've learned is in our business, you're going to be called by an acronym, and there are some terrible ones. There's SCRIMP. FIT was just, now we have the perfect fit. So I'd be happy to answer any question that anybody would have. I'm going to be here through the whole thing. If you think of it later, just come up to me or anybody on the staff. And like I said, the main purpose of this is to make sure we answer any questions you have. So just ask anything that you would like. Well?
Jay, I have a question.
Yes, sir.
On the example you were doing earlier about the other Florida pool where the surplus decreased over time from 22 million to 9 million, and were you referring to member dividends or price reductions or both in terms of giving back?
We sent them checks.
So year to year, how did you go about determining how much you would give back on an aggregate basis and then who gets what from a distribution standpoint?
The board voted on the total amount, and then they relied on us to go back, and we gave it back proportionate to the premium they paid in. So the board told us a certain amount. In fact, I think the first year was like $8 or $9 million. It was a big chunk the first year when they realized we got $22 million sitting there. So obviously, you got to be more conservative as it goes down. They saw it prudent to still hold 8, even though they've only got $33 million of written premium. But yeah, we just took it. The board told us how much to distribute. We went out and did the calculations, and wire transfers or checks. Most of the time we do wire transfers anymore, but. Yes, sir. Yes, ma'am. I heard it was about auto liability.
Yeah, that was our largest disproportionate increase that we were not quite expecting. So
Yes.
I just wanted to take, what is the State of the Union on auto?
That was the slide that I went. It's still not good. Things have been going up year over year. With us, we've had a pretty good year. So, we've had to get some pricing increases in auto like everybody. Our reinsurer is charging us more. If you got a hit last year, you probably won't get one this year. If you didn't get anything last year, there'll probably be something this year. Yes, sir.
Could you elaborate a little bit more on this active shooter and the mental health facilities and what that means to us?
Who would be the most appropriate person to take that one? I can, but I'm not sure my answer would be proper.
The reason I'm asking is historically the airplane industry went downhill because of liabilities that the lawyers sued, or the bartender gets sued because he served one drink to somebody went out and hit somebody, and there's an implied liability.
Right.
Is that where this is going?
It is. It's too early to say because none of this, unlike those examples, there's 75 years, the example of the person the guy went to 8 bars, you served him 3 drinks, and he goes out and hits a car. Who served him too many? There's a lot of case law on that. This active shooter is so new There's a ton of cases. I can tell you this. We have got one active shooter case going on. I don't think I'm allowed to name it, but there's 33 claimants on it. We're defending it vehemently. We're not sure at what point ours will get into the court cases, and it's really dependent on those first few initial findings. So nobody knows. The main thing for us is to make sure we're providing defense coverage for it, because at a minimum, we got 33 different cases to defend. But I really think, and again, this is my opinion, but I mean, the court, it's all going to come down to the courts. You know, if the courts say just because you treated somebody in your mental health facility and you kept them there for 4 days and then you let them loose for all the reasons, they met all the requirements to be let loose, and then they go off and do something bad, at this point in time, what I can say is you can almost assure, because of Marjorie Stoneman and multiple other ones, you're going to be sued. Guaranteed. Whether there's ultimately going to be any liability from the courts, we obviously don't think there should be. That's kind of silly. That's kind of like the analogy of somebody drank at 5 bars and he sues all the 5 bars. But that hasn't came out in the courts yet. So I don't think anybody can actually give you an answer. Yes, sir.
Shane, you said there's coverage now. Is that a separate policy or is it part of?
Ladies and gentlemen, Hasib Bangloria.
That's part of the property coverage form that we're offering. So we added that as an enhanced coverage. Now, active shooter coverage, I mean, it's a topic on its own, but there is coverage under your general liability and professional liability forms as it stands now. The active shooter coverage really covers counseling, has ancillary extensions like funeral services, counseling services, initial defense. There's crisis management or public relations coverage in there as well. So it's a lot of bells and whistles, but the meat of the coverage is still going to fall under general liability. Professional liability, where the negligence, it's likely a negligence claim or tortious claim, so it'll still fall under that purview. The active shooter coverage just rounds out the coverage to cover areas that aren't currently covered under the general liability.
So distinguish active shooter who is known to you with the role of the education versus somebody random on the street.
And I guess that this active shooter coverage is more for someone that comes in, whether it be an employee or not, and there's an incident that takes place on your premises. So that's what this coverage is for, not necessarily for the liability that comes out of, treating a mental health patient who goes out and commits criminal acts. So yeah, the active shooter coverage is really specific. It could be both.
Somebody who's on your premises shooting, but is also
Exactly. Yep.
It's good to have smart people. Any other questions for me? Yes, sir.
I get this way when I get to these meetings. Issues for my. Let's go back to workers' comp changes in the law. I think it was this year, now allows legal to be able to charge an additional amount for in claims processing.
That's correct.
That affected the ability. That affected premiums that we have to pay because of that change.
This is where the rate-making process is very politicized. NCCI, the governing body, calculates and they say, we think that this change, there's no numbers to base it off of, but we think this change means this, and then the state approves it. So right after those 2 court cases that you're referring to, which were about 2 years ago, NCCI came out and proposed 2 rate increases in a row, 9-point-something%. They totaled 14.5%. That was only 2 years ago. And they said, because we think it's going to drive up claims this much. Now, 2 years later, and you got to realize it takes a lot longer than 2 years for work comp to play out. But 2 years later, it's very political. And the politicians in Tallahassee said, you made the rates go up 14%. And the numbers that OIR has given us shows that the claims haven't gone up. They've came back now and proposed a 13% rate decrease. And again, the first one was unfounded, and this one is unfounded, at least in our mind, because they haven't given it enough time to play out. Where those things we're going to come into, the attorney's costs, are the longer term claims that have a lot of litigated cost. After 1 year, you've got the simple Met-only claims. I mean, you don't have those litigated costs. So, I mean, we think that they overreacted when they proposed the increase. We think they've overreacted when they proposed the decrease, but it gets very political. And in fact, we've got some political folks coming in to speak to you. That may be a good question to ask them. Why do you guys knee-jerk react so much? I'm not sure how comfortable they'd be with it, but like I said, it's a skirts up meeting. Anything else? Thank you guys very much. I appreciate it, and I'm around, so just grab me.